tell the audience about how you got started in real estate. Andrew, welcome to the podcast.
Thanks for having me, Tanner.
So want to get started in your background. You know, if someone told me there's a guy in his mid-30s who controls $1 billion worth of real estate, I'd assume, you know, Harvard undergrad, Harvard MBA, and moving that way. But you kind of got started in a different way. So let's start with there.
Yeah, no, first off, thanks for having me. This is great. And as far as the story, I don't know where you want me to start, but as of today, I run a company called North Rock. We're a multifamily value-add acquisition company, and we have about $1.3 billion in assets. Where do you want me to start? Go all the way back?
Yeah, let's go. Let's take it from graduating high school.
Okay. Luckily, I did do that.
Yeah, barely.
No,
early.
Yeah. I did graduate early. So in high school, I was never the kind of kid that wanted to stay where they were. I always was looking for the next thing. So I wanted to graduate early and go off to college. So I did that. I went to college for a year and didn't love it. It didn't jive with kind of what I was feeling at the time in my life. And I always kind of had this drive to keep, again, going on to the next thing. So in my young, naive mind at the time, I was like, man, why am I going to spend another 3 years doing this where I could be out in the business field starting my company? So I actually dropped out of college. So I have a little bit of a unique path. I dropped out of college. I moved back out to Arizona, actually. And I tried to start my own real estate company when I was 19. I started fixing and flipping single family homes, doing a lot of wholesaling, trying to learn as much as I could. And looking back on that, I knew very, very little, but things went really well for a short period of time. And then they went gloriously wrong.
I mean, this was what time frame did you get started?
Yeah, so I got started about a year before the great financial crisis. And so I was 19, young and dumb, didn't know what I didn't know, and was involved in the real estate industry and made a bunch of money, and then went about a year without making any money, and was living off of savings, and actually wound up at that time, just working from my home, trying to do odd things. I was trying to be a real estate agent, trying to flip homes on the side, also trying to be a multifamily agent. And quickly ran out of savings and learned what I didn't know. And at that time, somebody gave me a really good piece of advice. Back when the San Francisco bridges collapsed and there were cars trapped in between all of the rubble, a gentleman told me, okay, Andrew, I know imagine there's your grandmother trapped underneath the rubble and you really want to get your grandmother out and you're going in that direction and it's going to take you 20 hours to dig her out if you go start to finish. But if you pivoted your attention over here to the left and there was a San Francisco 49ers linebacker buried in the rubble right next to her, but you could get him out in 3 hours. So if you shifted your attention away from what you really wanted, which is your grandma, dug him out, he could turn around and assist you in helping get your grandma out in half the time. And that, for some reason, really clicked for me. And obviously, he was referencing schooling or college. And so for me, I was able to kind of put my own hubris aside. I went back to school. I went to Arizona State for a year.
Arizona State was the metaphorical linebacker?
Yeah, exactly. So went to Arizona State and trying to just figure out what I wanted. And I always knew I wanted to be in real estate. I got turned on to that at an early age by my uncle. And, but I didn't come from an entrepreneurial family. My dad was, work in corporate America for 40 years and retire on a pension kind of guy. And that just wasn't how I was made up. So I went back to school, and I actually met my my now wife while I was there in Arizona. We finished up 1 year and then transferred to finish my junior and senior year at BYU in Utah. And kind of along that transition, I was able to get an internship. I got an internship with a company called Sundance Bay. It was actually called Sundance Capital Group at the time, and they were fixing and flipping homes in Arizona, ironically enough. And so they quickly learned that I knew a little bit more about real estate and flipping homes than your average intern does. And so they hired me on full time, and I worked for them my junior and senior year and helped them grow into multiple different states. And we acquired somewhere between 300 and 350 houses over the span of the next 2 years. And we were flipping those. And then really there was an opportunity right about when I was graduating to buy a multifamily asset out in Sun Prairie, Wisconsin, of all places.
Every investor's dream.
Yeah, exactly. It was actually 2 assets, a 32 unit and a 50 unit. And we had been doing single family, so we were like, it can't be too much more difficult. We pivoted, took on that deal, and kind of a light bulb went off right there. And realizing that multifamily was more of a scalable model, we quickly sold all of the single family assets that we had. And to be clear, I was not a partner, I was just an employee. But we transitioned and shifted focus. And along doing that, we started multiple companies, started a foreign exchange hedge fund, started a debt fund. We started a water trucking company of all things out of Minot, North Dakota. But kind of we started a property management company. But kind of out of all those things, multifamily really stuck. So we did that. And then I worked there holding a lot of different jobs, a lot of different titles, I guess, working all the way up to head of acquisitions, and helped them buy about 5,000 units. And from that period all the way through about 2018, next step for me was great guys, great company, just a little bit top heavy for my growth trajectory that I wanted. And so I was able to I was looking at starting my own development arm. I was thinking about starting my own acquisition arm. And I was able to link up with a couple gentlemen here in Utah to create a new acquisition vertical, which we ended up calling North Rock. And over the last 4.5 years, acquired about $1.3 billion in multifamily assets. So that gets us to today.
Yeah. So stepping back a little, you go off on your own, or decide to go off on your own. Was it always multifamily, or were you thinking, maybe I want to start building apartments or buying retail, buying self-storage? What was kind of the thought process on that?
Yeah, retail's never been overly exciting to me. Office hasn't been. I've always gravitated towards multifamily and self-storage, and really because it's more of a business that I understand and would utilize myself.
It's very intuitive as well.
Yeah, and I always like the diversification aspect also, to where if you have a retail property that has 5 tenants and 1 leaves, you immediately go down to 80% occupied. Whereas if you have an apartment complex with 300 units and 1 leaves, you still are diversified across 299 tenants. So that always resonated with me, especially coming from the single family world, where it was either you were 100% occupied or 0. And there were a lot of sleepless nights going through some of that ebb and flow with that.
Been there.
Yeah. So when transitioning away from Sundance, I had learned a ton, and multifamily was kind of the space I had learned enough to be dangerous in. And my initial goal was to leave and start a new development company. I was actually going to do a multifamily development company at Boise, Idaho, which in hindsight actually would have done really well.
Yeah, I think you made the right decision looking back, though.
But yeah, through kind of relationships and a few peers, was able to connect with a couple of guys that that own some other businesses here in Utah, but we're not in the acquisition space. And so our alignment worked really well, and I'm grateful for that group. Gave me a lot of autonomy and scalability. So
Cool. So, I mean, you just mentioned from, was it 2018 or 2019 to today, 1.3 billion. I mean, that is like a rocket ship trajectory. So day one, you meet up with Blair and Shane.
yeah.
What's it like on day two?
Yeah, I mean, those guys are great guys, salt of the earth. They have, started, invested in, sold north of 30, 40 businesses, and are phenomenal individuals in their own right. And really, when we came together, they had done an acquisition vertical before, and had subsequently sold out actually right before 2008, and wanted to get back into the game, but wanted to partner with somebody who had the know-how from all different aspects, not just acquisitions, but also asset management, disposition, running a team, etc. And they really, I always say back then it was like, we partnered. I got a laptop and they let me have an empty office in one of their buildings. And they basically said, look, let us know what we can do to help, but we want to recreate, a large acquisition vertical. And that's something I really appreciate as partners. They knew what they were good at, and they also knew what I was good at. And they really allowed me a lot of autonomy in that partnership structure, to go do it and run it the way I wanted to run it. And for that, it was a kind of a dream partnership for me.
Yeah, sounds awesome.
Yeah.
So day two, you just start calling brokers that
Yeah.
Were you just all over the country, or were you dialed in 2, 3 geographies? What did that look like?
Yeah, no, that's a great question. I think there was some geographies that I had deeper relationships within the broker community. But yeah, when you start making those phone calls and, they were all excited and happy for me, but started making offers. Well, actually, let me back up. What was kind of funny is I got there and I wanted to make sure we did it right from the beginning. And so I still remember probably for the first month, I came to the office and I would make phone calls and create connections, but I basically rebuilt our entire pro forma and model and what we call our Reno workbook and a few other things from scratch. And because I wanted to have these internal processes in place right from the get-go. So I still remember a couple of the guys that were in the office with me. They were like, man, this guy comes to the office, closes the door. We don't hear from him until 6 or 7 at night. And then he gets out of the office and leaves. They're like, what is he doing in there? So I spent the first month really creating the documents and the framework for the business. And then that was kind of January 2019. And then really starting in end of January, just started hitting the phones and calling people and underwriting deals. And I mean, I was the only guy, so I was doing everything from start to finish myself.
So you're calling these brokers and saying, I haven't done a deal by myself, but you're going to love it. Send me your best deals. Like, well, how did those conversations?
Yeah, there was, it was like, hey, we're starting this new company. You get on the list and you get the deals, then you underwrite them and you start making offers. And so you can kind of get 3 or 4 steps down the road before the I'm brand new starts to become a hurdle.
Yeah.
You start making offers and you get into the top 5 or 6 on the bid sheet. And then all of a sudden you're, start competing and you get into the top, 3 or 4 on the bid sheet. And then you go to something called a buyer interview, where you get on that interview, and before you get on the interview, they send you a questionnaire. And on that questionnaire, it asks you a bunch of questions of, how many deals have you done in the last 12 months? What markets are they in? How large are they? And I just had to write 0, haven't done one yet, And that I would say was the biggest hurdle. I think I got 2nd or 3rd place on 8 or 9 deals before a broker that I had a great relationship with for probably the last 5-6 years prior to starting North Rock, really advocated for me in a buyer situation. I'd get on the phone and talk with the seller directly, and then he really pushed. And once we got the first one of anything is always the hardest, but that first one definitely was tough.
So what was that first deal?
Yeah, that first deal was a deal called Mandalay Villas. Actually, it was 300 units out in south side of Atlanta, Georgia. And it was a great product. And it was kind of early 2000s vintage, big house style. So meaning kind of almost townhouse style with large garages and things of that nature. Bought it. The story on that one is the group that I was buying it from had bought it with a loan that required them to renovate it in a very short period of time. And so because of that, they were renovating very quickly. Occupancy had dropped. They were using revenue management. Because occupancy was dropping, it was also pushing their suggested rents way down. And what was interesting is the developer that built Mandalay Villas had also built 2 other communities using the exact architectural floor plan. So I could literally drive 3 miles down the road and see Mandalay Villas number 2 and then Mandalay Villas number 3. They were obviously called something different, but it was great from a comparison standpoint. And what was really interesting is the seller had gone through and renovated 75% of the units, but were getting lower rents on their renovated product than the competitor that was the exact same thing was getting on non-renovated product. So the thesis was they've mismanaged the asset. They've already spent 75% of the money that needs to be spent. I can come in and buy it, fix operations, and I can push rents to where they actually needed to be without actually having to spend the money on the deal.
That sounds like a good strategy. Stepping back, was it always over 200 units, or did you say maybe I'll start with 40 or maybe I'll start with 50, but you just said I want to go to the top immediately? What was the thought process?
Yeah, I think in my mind, it was always larger units create more efficiencies. And candidly, a 300 unit deal is the exact same amount of work as a 30 unit deal. It's probably even less work than a 30 unit deal. Which sounds counterintuitive, but
it's so true.
But it is true.
I work so hard on my small deals. It's sad.
Well, the larger deals have a big enough, big enough P&L where it can support a team on site. And so they're getting the phone calls rather than you getting the phone calls at midnight or something. So yeah, I think the idea actually was to go after smaller deals. I still remember my partners at the time, they said, okay, well, let's go out and find a deal where we only have to raise $4 or $5 million for the deal. And I went out and I got Mandalay Villas under contract, and we had to raise $16.5 million for that asset. And they, took it in stride, took a big gulp and said, all right, let's go figure it out. And we were able to raise the money for that deal in less than 30 days. And I think that's what really expanded the momentum of now going after larger assets. And so our strategy to date, we've bought 1 or 2 assets that are slightly below 200 units, but usually it's somewhere between 200 and 500. And every single deal we've bought really falls in that category.
Is there any real difference between, I think of going from 50 units to 100, that's a big dollar amount, but is there really any difference between going from 200 to 500?
From an operational perspective?
Yeah, I guess operational, just really anything.
It's just more equity that you have to raise up front. But I would say from an operational perspective, not really. I think you just have to, yes, you have a bigger team, and you have to renovate more units every month, but really once you create the playbook and know what you're doing, renovating 5 units or 10 units a month or 15 units a month isn't much different, right? It's just kind of rinse and repeat. But the bigger issue, which I know a lot of people out there struggle with, including us, I don't want to make it sound like it was super easy. is that upfront equity requirement that you have to go raise. And so a 200 unit deal might require, 10 to 15 million of equity. You go buy a 500 unit deal, you can 2.5x that number, right? You're going to have to go raise $30-35 million. And that in and of itself is inherently difficult.
Yeah. On that first deal, I mean, you had a bunch of experience at your previous job doing these deals. What was something, maybe a couple things that when it was just you by yourself, you're like, oh, I didn't really expect that?
Yeah, that's a great question. I think I didn't fully appreciate that all of a sudden when you start your own company, you spend 50% of your time reviewing contracts and almost being a wannabe lawyer.
Yes.
And so that was really new for me because we always had somebody that was doing that for us. And when you're a young, small company, you do everything by yourself.
Company.
Yeah, exactly. I think the other thing that has come over time, but started immensely once we started raising capital, even for the first deal, is just the weight that you feel when other people are entrusting you with capital. When I worked for somebody else, they weren't necessarily entrusting me. They were entrusting the partners, and I had a job to do. But when you sit across the table and have to talk to somebody and say, this deal is going to be this, and they entrust you with their capital based upon what you've said, there just is this light switch of immense fiduciary responsibility, which I think is a term that gets a lot of, it's basically a fancy term for there is just a tremendous amount of weight and responsibility that you should feel and to do the right thing by those investors. And that is probably the number one thing that I could not teach anybody. You just have to experience that. That's where some of these gray hairs have come from, and a lot of sleepless nights, but it's what I wanted and what I asked for. So,
yeah. Okay. So moving on from deal number one, what time frame was this? January or,
so we bought our first deal in June of 2019.
Okay. When was deal number two?
So deal number two, we got under contract about July of 2019 and closed, I believe it was October.
Okay. And what, kind of talking about the trajectory of North Rock, when did you start hiring people? Who were the first couple of hires that you made? How was the team kind of expanding as you were expanding the portfolio?
Yeah. So, I was technically the only full-time employee, but I knew I needed some help just underwriting deals. I mean, historically, we underwrite approximately 100 deals to win one. And so it's a numbers game and it's a slog, and it's a lot of effort, right, from that front. And so it's just kind of more hands and skill set to be able to get through those deals. So I actually brought on an intern to help me with acquisitions and taught him the ropes. And he subsequently became the first hire. Great guy, had the opportunity to go to investment banking with Goldman Sachs out of San Francisco. Super sharp kid from the University of Utah. And I don't know if I got him to drink the Kool-Aid or he saw the light or what, but he wanted to join a fledgling real estate startup, and I was able to, get him on. So he was our first hire, and then very quickly I brought on an operating partner, and so there was a gentleman who was a CFO of multiple of Blair and Shane's companies, my other partners, and was able to get him and convince him to come over to North Rock and be a managing partner with me. And so that was like kind of the first three. And then we're at 13 full-time employees today. And then we have about 3 to 5 interns at any given time. So.
Okay. And so we jumped ahead a little bit, but so you start buying deal number one in June, deal number two in July. when were the rest of the acquisitions? Because there were 21, 22
Yeah,
acquisitions.
21 assets. Yeah. So we bought 3 in that first year. And so we did about $100 million worth of transactions. Or I apologize, number 3 actually fell into February of 2020. Right.
Great timing.
Yeah, it was perfect. So we bought 2, which represented about $100 million worth of deals in 2019. In 2020, we bought about $250 million. In 2021, we bought about $400 million, a little over $400 million. And then 2022, bought about $225 million. So we started scaling back as that market started to get overheated. And then here in this year, 2023, we've closed 1 asset, a $75 million acquisition.
That's a big one. Let's talk about that one for a second. 2023, I think a lot of people, I feel like every year since I've started in the business, they say next year is going to be a great time to buy a bunch of distressed assets.
Sure.
2023 consensus was kind of on the sidelines. What about it? What about that deal made you say, I want to go and buy this?
Yeah. Yeah. And I would say we have been underwriting deals with the same amount of fervor the entire time. So we have never stopped underwriting deals, but we knew that coming in 2020, end of 2022, 2023, there was starting to really show the cracks in the lining. And so we pulled back our appetite per se, and really fine-tuned the focus of what deals would make sense for us at that time. And the reason this deal, so it was a $75 million deal on Charlotte, North Carolina. And we had transacted with this seller twice before, bought one from them, sold one to them. And they were selling this deal off market, actually. So they brought it to us and about 4 other buyers. And we underwrote the deal. It had fixed rate loan on it, but cap rates had devalued a little bit. So cap rates in Charlotte were in kind of the high 3s there for a while. We were able to buy this deal at a 5 cap, but it had in-place loan of about 2.7% interest. And so we were immediately able to take that arbitrage right up front. Had about 8 years left on the loan. So for our investors, it started with a high cash on cash right from the get-go, and it just was an awesome opportunity for us.
I'm so jealous. I would love 2.7% interest rate debt. Okay. Let's walk through kind of a fastball deal for you. We'll say credit markets, interest rates, overall economy aside. We'll say everything goes perfectly. What does that deal kind of look like? What location, what price point, age of the building? What are you looking for?
Yeah, and are you talking about like in coming into 2024 or just in a normalized?
Well, we'll say normal, and then you can kind of compare and contrast how that looks with, your economic outlook.
Sure. So I would say in kind of a normalized market situation, we are typically looking for a deal, A minus, B plus type asset, kind of 1990 and newer, maybe 1980s and newer, that has, on one hand, an operational upside component where you're buying it from a manager who is either, and believe it or not, in these multi-million-dollar assets, there are sleepy owners that don't pay as much attention as they should. So an operational component, which might mean increasing revenue from a mark-to-market strategy, decreasing expenses by bringing in better professional management. But then also, secondly, there is a renovation component. With those older assets, you can come in and spruce them up a little bit and typically charge more in rent.
What does the scope of your typical renovations look like? Is it paint, carpet, appliances? Or are you ripping out cabinets and countertops? What does that look like?
Yeah. So to answer that, in my prior life and my prior firm, we were doing much heavier value add stuff where we would sometimes even go down to the studs. I mean, I worked on deals that had a $40,000 per unit renovation where some deals we even spent more on the renovation than we did to buy the asset. I remember we bought a 17-story high-rise in downtown Louisville, and we spent more on the renovation than the acquisition price.
Wow.
And There was another deal that we did that with as well. And so those ones were really fun because they were very transformative.
Yeah.
They were very transformative. So what you started with versus what you ended with. And I could tell some stories about those deals, but that include hazmat suits, police, SWAT teams, etc. But those deals, while fun, gobble up a tremendous amount of time, energy, and effort. And candidly, they're not as scalable, right? If you have to divulge or dive in and spend that much time on one asset, it prevents you from spending time on others, right? And so when starting North Rock, and also knowing that we were kind of later in the trajectory of a growth market, I wanted to focus on deals that were more in kind of the $3,000 to $10,000 a unit renovation. So we're not ripping out cabinets for the most part. We're doing paint, carpet, light fixtures, plumbing fixtures, maybe new countertops, new appliances. And that's on the interiors, and then typically renovating all of the amenities with prioritizing the clubhouse.
Okay, so I think you kind of answered it, but do you start with the exterior around the entire building and then you start renovating interior units, or what does it kind of look like day one that you buy a property?
Yeah. We do a lot of what we can during the due diligence period, because typically an acquisition takes you about 60 to 90 days to close. And so we're out there multiple times trying to understand the design, understand the contractors we want to use, and for the most part, get a lot of that in place to get started as quickly as possible once we acquire. We really bucketize it into interiors and then everything else, right? Our amenities. And so we try to execute the amenities in the first 6 months of the deal. And some of those, namely clubhouse and landscaping, are really dependent upon seasonality, right? If you're in the heat of July, where it's your best leasing season, you don't want to shut down your clubhouse, right? Because that's going to impact the demand and for your leasing. Also, you don't want to go and put in a bunch of brand new landscaping and spend, hundreds of thousands of dollars on landscaping right before winter. It just kills it all. So with that being said, we typically try to experience or finish all of the amenities and exteriors within the first 6 months. And then our interior renovation plan, depending upon the size of the asset, but predominantly takes anywhere from 2.5 to 3 years. We are not forcing vacancy. A lot of times historically on my previous shop, where we're spending that much money, we would vacate an entire building and redo the building all at the same time. That is not the case with what we're doing. It's really on move out and on natural attrition. We will go in, renovate the unit, and release it.
Are you trying to really push renewal rates, or is it just kind of market rent bumps, and if they move out, then we renovate it?
Yeah, no, we are aggressive on the mark-to-market strategy. Yeah, and over the last several years, we've seen exorbitant rent growth. And so because of that, you have something called loss to lease, where you have somebody who moved in 12 months ago who might be paying $100 or $200 or $300 less than what that unit would rent for today if it was empty. And so with that mark-to-market strategy, yeah, we do get fairly aggressive in trying to bring the property up to today's standards from a rent perspective. And sometimes our tenants want to stay, and sometimes they want to move on to greener pastures. And so we once we have that unit vacated, then we will choose to renovate it at that time.
Okay, and kind of going back a little bit, before you buy it, what kind of metrics do you care about? Are you total return IRR buyers? Are you looking to flip this thing in a year? What does that look like for you?
Yeah, and I'm gonna give you the old adage that nobody loves. It depends. It depends upon the asset, right? A lot of times brokers will call you and be like, "Hey, will you buy a 6 cap deal?" Well, it depends, right? Will you buy a 2 cap deal? Well, it depends.
Yeah.
I've bought deals that are negative cap rates before, where I bought a deal that was only 60% occupied and the expenses were more than the revenue. So does that mean that the property is worthless? No, there's intrinsic value in the asset that if you could go in, clean up operations, and fill up the remaining 40%, you absolutely can create value, right? And so typically the metrics we look at, and we look at a lot of them, but we look at demographics of a market, I think is a really big one.
Let's go into that for a second.
Okay.
So you're based out of Utah, but you're buying stuff in Georgia, Virginia. Why those two places?
Sure.
And where else are you buying, I guess?
Yeah.
North Carolina.
So right now we're in 5 states. So we're in, Arizona, Georgia, South Carolina, North Carolina, and Virginia. And there's a lot of other markets that we've tried to get into, and we've just been either priced out or the competition was too steep and we haven't won. Some of those markets being Florida, Tennessee, Texas, several markets in Texas. Utah is a great example. I would love to own product here.
Me too.
Utah. And you own more product in Utah than I do.
What can I say? So,
But yeah, no, sometimes we're going to markets that will pay, as far as a return goes, what we think our investors need and want for the risks that we're taking on. And it's a good dichotomy. For example, going to Atlanta, we could buy deals that were a 14, 15, 16 IRR type acquisition. Whereas here in Utah, you had so much money coming from California and they didn't want to take a 4.5 hour flight. They wanted to be able to just jet over to Utah quickly. So they were willing to pay a price that equated to a 10 or 11 IRR. And for us, we were willing to take the flight in order to achieve the types of returns we wanted to achieve for our investors.
is there any, kind of on that demographic note, are there any, do you look at job growth? Do you look at, population? Anything particular that said, I want to get in this market outside of the, expected returns?
Absolutely. So, and I know I kind of led with the return aspect, but we actually do a nationwide data analysis project twice a year. And so we get a lot of data from sources like CoStar, Yardi Matrix, Axiometrics. These are all kind of data suppliers for the multifamily real estate market. And we put it all into a very comprehensive Excel analysis. And what we do is we go through and we have different metrics that we track and we weight all of those differently. And we don't even just look at the markets, we dive in and look at the submarkets. Like for example, Phoenix, Arizona, I think has 29 different submarkets. So it's like all these different pockets, and each one of those operates and has different economic or population drivers as well. And so what we do is we do this analysis of all the markets across the country and then rank sort them to see which ones top the market. And that's what really drives our investment decisions.
Can you talk about, I don't want you to give away like the entire recipe, but kind of some of those metrics that you look at and say, I care about that, or I don't care about this?
Yeah, absolutely. So we look at things like, again, they're kind of broken down into different segments, but one being demographics and what's happening with those demographics from a population growth standpoint, even down to like wallet share of the demographics. So like median income versus what the housing costs. We would back into what an example mortgage rate would be, and we compare that to rent in the markets. We would look at housing supply versus absorption and demand. We'd look at tax rates even across the different municipalities to see what we thought would bring future economic growth. I mean, we're seeing that across the country, right? Companies are leaving these kind of oppressive tax environments at a state level and moving into other areas, which brings jobs. I mean, housing, without trying to overcomplicate it, housing really is where jobs and bodies have to be. And so if you have a market, for example, like Arizona or Dallas, Texas, or Orlando, Florida, where there's a lot of people congregating into those spots, they need housing, and that drives up demand for the housing stock that's already there.
And so kind of on that note of different markets, how do you maintain not being that California company that's coming in and buying stuff at a 10 and 11 cap when, maybe they were expecting a 20, how do you stay away from being that out of town idiot, and how do you develop those relationships?
Yeah, that's a question we actually get asked quite a bit from our investors, because they ask, well, why don't you just buy here in Utah? And that's a really good question and tough to execute on. So how we really do that is by aligning ourselves with local experts. So property management companies, broker relationships, and then there is no substitute for just boots on the ground. So we will take a lot of trips. We fly out to the markets, we meet with the brokers, we meet with different contractors. We'll actually meet with the property management companies. We'll go shop a lot of properties and try to understand the markets from a deeper level. And by spending time in those locales, we can ascertain, I'm sure we don't understand it as well as, say, somebody who grew up in Charlotte their whole life, but we try to ascertain at least enough to be dangerous to where we can help understand whether we're making a good decision or a bad decision. I think another way to do that is a lot of comp analysis. If you are an outlier in either the cap rate or the purchase price per unit, or choose any other metric, if you are some outlier, there's a way for you to understand what kind of the band of normalcy is from an acquisition perspective in a given market, just like Zillow does for your home, right? It takes comps from around and gives you an idea of what your house is worth. We do that, generally speaking, across the nation.
But you're way more accurate than Zillow, right?
Yeah. Yes. So, well, we try.
Yeah. Okay. So going back to kind of the business plan and the execution, what are some things that you think North Rock does that maybe less sophisticated or less good operators are doing? What kind of separates you guys from the rest of them?
Yeah, that's a great question, because there are so many really smart people out there in the real estate world.
Lots of dumb ones too.
Yeah. Well, what we try to do differently is, how to put this, I think it's our level of care. And what I mean by that is care about the asset, care about our residents, care about our investors. And so what that makes us do, because of that level of care, is go the extra mile, dig a little bit deeper, take the next step in understanding either the market or the asset or the solution for the problem. And for us, that, I would say, is our kind of the ethos of North Rock is we try not to go just 6 inches deep. We try to go 6 feet deep and try and understand as much as we possibly can. And hard work doesn't scare us. I think secondarily, we try to take that level of analysis to the next, to that deeper level. Like, for example, right now we're building out an internal software company. We looked and had demos with all the different providers of data analytics or BI, business intelligence softwares out there for the real estate world. And none of them really took it to the depth that we needed to be truly actionable. And because of that, we're willing to spend money and create it ourselves to make ourselves top tier asset managers.
What does that software entail? I mean, what's the difference between you and your, we'll call it fancy software, and me and my Google Drive? Like, why is it so much better?
Yeah, sure. I don't want to knock on Google Drive, because I actually was using Google Drive for, probably 90% of the front side of my career. And I think the difference is every single Google Drive or Google Doc is only as good as the person that creates it, right? But inherently there's potential for issues, there's potential for formulaic errors, there's potential for outside manual input error. So we actually used to have documents that with each one of our assets in North Carolina, South Carolina, Georgia, etc., where we had a contractor who was inputting data. We had a site manager, a regional manager, and then our own asset manager here in Utah, all inputting data. Well, when you have a bunch of different input levels on something as simple as an Excel spreadsheet that's shared online, one person makes a fat-fingered delete or changing a unit number or something like that, it can disrupt decisions going forward on a multi-million-dollar asset. And so one is security and control of the data. I think two is the way we think about different metrics and different steps on how do you decide at what level to send a renewal. Do I give them a $50? Do I give them a $100? Do I give them a $150 versus the probability of that person moving out? It's all coming down to like price elasticity and how to gauge how you can get the most revenue and squeeze the most revenue out of that unit as you possibly can. And while some people might not want to make it that complicated, we do, because we believe, again, that when we're entrusted with those dollars, that we do everything we possibly can to maximize the return on that dollar.
I would say that's a little different than me and my Google Drive for now. So someday I'll catch up to you. Okay. Getting into the economy and what you think that looks like over the next coming, we'll say 18 months. What does that look like for you?
Yeah. So man, if I had a crystal ball,
wouldn't be buying apartments.
I wouldn't be buying apartments, but I think in all of the data that we're seeing right now, and I'll try and summarize this as much as I can. What has occurred over the last, really since COVID, I don't think we have seen. There's the quote of, history doesn't repeat itself exactly, but it rhymes. And I think what we saw during COVID was mass government intervention. And it was very similar to how the government does it. It was an overcorrection. The amount of stimulus and the amount of money that was poured into the economy in an unregulated way, right?
It was awesome.
Whether through PPP or whether it was incentivizing individuals to either get laid off, quit their jobs, or even those that unfortunately lost their jobs because of shutdown, they were given incentives to not go back, right? And I think that created this very unique parameter where people stopped working and stayed not working and were collecting more money than they should. And it became this perpetual thing that the government had to continue. And so they just kept printing money, which escalated inflation. And so I think what that's gotten us all the way to today is obviously we've seen a massive correction by Jerome Powell on the interest rates, and seeing
awesome.
Yeah, not as awesome, right? Seeing 550 basis point increase over 18-month span. That's the fastest hike we've ever seen in the last 40 years. And having an inverted yield curve, having, credit card debt be the highest that we've ever had here in the country, having the interest rates being paid on the debt by our society being the highest it's ever been. Starting to see cracks in the lining of default rates on cars, default rates on homes even. There's a lot of, again, cracks in the lining of the economy that really you don't see when you watch, MSNBC, who's ever watching that.
I have not watched it.
Yeah.
I'm not watching.
Whoever sees the news and those they're not talking about it in a real capacity. They're starting to. They're starting, as these issues started to become much larger and more front facing, they're starting to. But I think that we are in for a recession. I think that 2024 is going to be really difficult. That hasn't hit the general public like the housing crisis of 2008 did, where everybody's personal home became a toxic asset for them, right? Normally you think of owning a home as a good thing. Well, owning that home became their worst nightmare at that time. But that hit the individual consumer. I would say we are going into a recession, but I would say that the commercial real estate recession has already started. We're seeing across the marketplace, 25, 30, sometimes even 35% reductions in the multifamily space. You look at other asset classes like office and it's even worse. And so for us, while that is difficult, and we're not immune to some of that difficulty, we see that as also an excellent opportunity to be able to go and acquire assets at a basis that we haven't seen in over a decade. And so that's what we're prepping for and excited for.
So when do you jump back into the market? At what point are you like, all right, we're going to go deploy $500 million? Is it, a certain yield requirement? Is it interest rates going lower? What makes you say, all right, I'm ready to go back in?
Yeah, again, back to the crystal ball comment. I think what we're trying to do is understand when has enough pain occurred in the marketplace to where
already.
Yeah, well, yeah. So there's a lot already, but are interest rates going to keep, like, for example, interest rates on a single family home today are in the 8 range, right? 7.5 to 8. But historically we've seen them go up as high into the mid-teens. And so are we going into a market where that can occur, right? And if you buy now and that occurs, then you're hosed. But do we think we're peaking and topping out? And if so, now's the right time to start buying. So internally, giving a little insight to us, I'm not saying that this is the bottom of the market, but we at North Rock want to start acquiring kind of end of Q1, early Q2 of 2024. I actually don't think that's completely the bottom, but for 2 reasons. One, when we start acquiring, we're going to have a longer term hold mentality. And so we will be able to weather the storm for the next 6 or 12 months if there is any additional decline, knowing that we've already experienced a massive reduction. And even if we capture 90% of that upside, that'll be a great asset. And secondarily, once the large groups, I have a couple in mind as we're talking here, but you think of the Blackstones of the world or the KKRs or the Carlyle groups, once those guys start deploying the massive amount of funds that they have raised over the last 24 months, I believe there will be a pop in the market and a lot of that will get absorbed and the really great buys will be off the table. I've seen that once in my career already. And so we believe that even if we start acquiring just a little bit before the bottom, that knowing that we have a 7 to 10 year hold trajectory, that we will capture a majority of that upside.
So you talked about weathering the storm, and I think it's kind of common for everyone to say, like, everyone's going to get toast except for me, or except for these groups.
Sure.
What are you going to do that helps you weather the storm where other people can't? Are you capitalizing your deals differently? Are you operating them in a certain fashion? How does that work?
Yeah. So for us, when we start acquiring again, so historically we've been about 70% fixed rate and about 30% floating rate. And so our fixed rate assets, as long as you have a long enough period of time to stand the test of the, peak to trough, back to peak, as long as you have enough time frame in your debt to span that gap, you'll be just fine. Luckily, real estate is a cyclical market, and we've seen that in history, real estate does continue to go up. It's not in a linear fashion. There is ebbs and flows as we're seeing right now. But as long as you choose the right debt vehicle, usually you can get to the other side fairly unscathed. Now it's those that chose the wrong type of debt or were forced into a bad type of debt that may have to play different cards or shuffle the deck in a different way to try and preserve themselves. But going forward, when we start acquiring again, we will be using a fixed rate or a synthetically fixed rate. I guess you can say. We can get into the details of that if you want.
Would love to.
Okay.
Yeah.
So fixed rate is fixed rate. I mean, you can go and get a 5-year, 7-year, 10-year Fannie Freddie loan. You can get a long-term loan from other groups as well, whether it's a balance sheet loan or whether it's a life co-loan, or you can go get a floating rate product, but that has a hedge against it. It's called an interest rate
caps. Yeah.
Yeah. And, what's interesting is when interest rates are high, that's actually the best time to use floating rate debt because there are several benefits to having floating rate debt in a declining interest rate environment. Now, that's also the time when people are most fearful and still licking their wounds from floating rate debt. So I think when we start acquiring, we will use a mixture of the two. But if we do go floating, we will have more synthetically fixed.
So I don't want to quiz you on this off the top, but I mean, what is the difference between buying floating rate with caps versus just fixing? Because you're paying for both. in a way. Where's kind of the break even between, whether it's your yield maintenance or your prepays and just the cost of those rate caps? Like, how do you look at that?
Yeah. And
this is a selfish question, by the way. So
no, it's a good one. And again, it's one that says it depends. Where if you have a long-term mentality hold, right, versus a short-term, the recommendation on the debt product is very different. I think the inherent positives on a floating rate deal are, one, you can refinance almost at any time for a fairly nominal fee, right? If you get fixed rate, you can get hit with really large prepayment penalties. The deals of our size, we're talking about $5-10 million prepayment penalties. Okay. And that will really hurt returns.
I would assume so.
Sure. So, but you can also sleep well at night knowing your interest rate's fixed. So the synthetic option where you get floating rate and you buy a rate cap, I think one thing that's the one way to think about that first and foremost is just, what is my time duration on this deal? If you're going to hold a deal for 10 years, I wouldn't necessarily recommend, and you go into it knowing that, wanting that, experience it. Like if you're a family office and you just want to own a deal for cash flow, I would say go fixed rate, just forget about it. Okay. But if you're somebody that's trying to optimize values, I think floating rate is a really good option to consider in certain interest rate environments. I think when interest rates are at the peak of what we think they are going to be, then absolutely your downside risk or the risk of interest rates ballooning up past that much higher, the probability of that happening lessens dramatically. But as far as when to buy a rate cap or when to not, that all comes down to how good your crystal ball is and
not good,
and how much risk appetite you have.
Not much.
And so, yeah. So right now, for example, another synthetic way to create that is we're looking at doing deals where we would actually do a 5-year loan, fixed rate loan, but then buy down, meaning by increase the interest rate slightly, the yield maintenance from 5 years down to 3 years. And so typically if we were going to get a floating rate deal, our business plans are about 3 years anyways. And so if we wanted to have a recap event at the end of 3 years, we wouldn't necessarily have one at the end of one. So there'd be no point to us in having a 1-year option. So having a 5-year fixed rate loan, but then buying the yield maintenance down. So at the end of 3, it effectively acts like we have no prepayment penalty and we can either refinance or sell at that time. But if the market isn't in a place where it would be positive, then we can hold on to that for 2 more years without having a gun to our head.
Sounds nice. Yeah. All right. So kind of going back to North Rock as a company, what are your plans for expansion? We'll say we get through the next 18 months. We're both here back in the studio alive. What's your expansion plans? Other assets, just more multifamily? What does that look like?
Yeah. So, the funny thing, sorry, I shouldn't say it like that. It's not funny at all. There's actually a lot of pain going on. But the interesting thing about cap rates changing is that doesn't just affect multifamily, right? Cap rates rising affects and devalues all asset classes, all commercial real estate assets, whether it's hotels, self-storage, industrial, multifamily, office. And so for us, it provides an opportunity to start acquiring assets that we believe we want to hold long-term and in the future. And so when I talk with my partners, we kind of come together and say, what type of assets do we want to own long-term? And multifamily is the big core fundamental trunk of North Rock's culture. Absolutely multifamily. So I'll start there. We have about $1.3 billion now. Our goal is to buy once we start acquiring in early 2024, we want to acquire about $1 billion a year for the next 2 to 3 years and take advantage of this big dip in the market. With that being said, probably 12 to 18 months from there, we want to start acquiring self-storage and industrial assets as well. Do I want to wake up in 30 years and own a bunch of hotels or retail? Not really. If I wake up 30 years from now and own a bunch of multifamily and self-storage and industrial deals, I sleep pretty well at night. So taking advantage of kind of the store being 35% off everything, we want to go buy a bunch of multifamily and then start getting into the self-storage and industrial realm.
Cool. I think I'll leave it there. This was awesome.
Excellent.
Thanks, man.
Yeah. Thanks, Tanner.